Hello and welcome to this very special episode on money control. I'm Mahalakshmi. The one thing and the only thing that the markets have been really fearful of all of this year is the rate tightening. And who better than a very authoritative voice on interest rates to join me on this show today? James Grant, the editor of Grant's Interest Rate Observer. He's a very authoritative voice on interest rates, economy, and he's been doing this for a living for the past 50 years and seen so many market cycles. Jim, thank you so much for granting me this opportunity. It's a pleasure talking to you.
Well, you are entirely welcome. I'm delighted to be here.
Yeah. So, Jim, one of the things is you have emphatically said that this inflation is really a result of easy money policy, which all of us sort of recognize, but not just post COVID, but right from the economic crisis of 2008. It's just that you point out that the inflation did not get triggered because the money was either lying with the banks or the Federal Reserve. The moment it got into the hands of the consumers, it triggered a huge inflation. And that, of course, also got compounded by all the supply constraints that came after the war with China's zero COVID policy, all of that together. What is your take on inflation now? Because still last week, there was this feeling that inflation might have just peaked out. Do you really believe that it has peaked out?
Well, first and foremost, of course, we can't really know. All of us may take a guess, but I think it's important to let this play out and not jump to conclusions. The great inflation of 1965 to 1980 may or may not be an exact forerunner to this. We may or may not have a comparable experience, but to illustrate the dynamics of that inflation, it began in 1965, and no sooner had it begun than eminent economists and politicians, I guess politicians are not eminent, but economists, politicians, central bankers, stockbrokers seemed to compete with each other to declare that it was over. And that inflation went on for a decade and a half, 15 years. And it ebbed and it flowed. It was not a straight line. And so the question, I think, is what are the underlying dynamics of inflation? And I would say that those dynamics are unfavorable and that we should expect a persistent inflation rather than one that has peaked and will conveniently then disappear. So I would say to be prepared for more of what we have seen in the past year and a half or so.
So, can you elaborate on that? What are the underlying dynamics of this inflation?
Well, I think first and foremost is the propensity or the tendency of the central banks of the world to overdo it. And, we have, since the early 1970s, we've been living in a world of unconstrained paper currency issuance. The gold standard, or what remained of it, disappeared in August of 1971. And since that time, the past half century, we have been operating under what we at Grants call the PhD standard of improvisational monetary management, meaning that former tenured faculty member of the nation's leading economics departments are in charge of guessing how much money the world needs and then proceeding to print it and proceeding to set interest rates with an eye principally to accelerating economic activity. So we have been in an era of very easy money and very unconstrained money issuance, and then again there is the political dynamic of an inflationary era, and by that I mean the tendency of governments to promise and deliver more goods and services than the economy is currently producing. So I see, for instance, that in Europe, the crisis in natural gas prices and electricity generation generally has led the European Union to allocate something like 250 billion euros to subsidizing electricity and power consumption. And that tendency to help people in need may or may not be a laudable thing in the public sphere, but it is a general impulse in the public sphere, and that too tends to fan the flames of inflation. So I think both from a political point of view and from a monetary one, the tendency has been one to overdo it rather than underdo it. And lo and behold, we now have an alignment of the stars that seems perversely set to exaggerate and to amplify these underlying tendencies. So whether it's the war in Ukraine, whether it's the drought in the Northern Hemisphere, whatever it is, it seems to be perversely calibrated to deliver the most aggravation and the highest prices. So that's where we are.
Sure. Is it possible to decompose and say how much of this inflation really is the supply side inflation, and therefore how much of it is really addressable by the central bank?
Uh, um, no, one may not exactly decompose it. Yes, one ought to try. And I notice in the case of the Reserve Bank in India that the growth in the broad money supply since 2020 was rather moderate compared to what happened in my country, America. In the United States, broad money grew something like 40%, 40%, over the course of a year and a half, which is an immense increase in purchasing power. And as you indicated earlier, prior examples of monetary stimulus were mainly neutralized because those funds turned out to be, as it were, locked up or captured within the banking system. They did not get out into the broad commercial economy. And what has been different this time is the infusion of this newly created money supply into the pocketbooks of people who actually spend it. So I would say that the monetary impulse has been an important, if not predominant one. But inflation is very complex. I think the monetarists are a little bit too dogmatic in asserting that inflation is always and everywhere a monetary phenomenon. Of course, it must be monetary because prices are measured in monetary terms. But there are important events off the monetary stage that have contributed to our troubles, and one must take it in as kind of a complex system rather than one that can resemble a kitchen sink with two faucets, hot and cold. But I think without the contribution of governments borrowing, and with the Federal Reserve or the Reserve Bank of India, as the case may be, without the central banks facilitating these excess monetary impulses, without that, there would not have been anything like the current inflation.
And Jim, how far do you think are we from the targeted 2% inflation rate in the US? Do you see this getting resolved in 1 or 2 years, or do you think we are getting into an era of elevated inflation and therefore elevated interest rates? Because one of the things you also point out is that this interest rate cycle itself is very long. We've had for 40 years a downtrending interest rates, and before that, 15 to 20 years of uptrending interest rates. How do you see this really playing out over the next few years?
Um, as you say, these cycles are can be very, very long. You have to be a gentleman of a certain age. In fact, you have to be as old as I am, which very few people are, to have seen a time of persistently falling, persistently rising interest rates. Interest rates have fallen, or had fallen, from 1981 until about 2 weeks ago. It was an extraordinary, protracted bull market in bonds, meaning a persistent and irregular decline in interest rates. And interest rates declined to uniquely low levels. In fact, one could say that they reached 4,000-year lows. So what now? Well, there is the chance that we are embarked on a new cycle of rising rates. I happen to believe that. And we have seen 3 or 4 such cycles since modern financial markets came into being. We saw one most recently, and indeed it was not so recent, but we saw one that began in 1946 and that ended in 1981. That was 25 years of rising rates. In my country, again, interest rates began at a level of about 2% and stayed at that very low level for about 15 years, but began by the time the 1960s rolled around, began to climb and then to leap and then to rocket. And finally, that 2% rate became a 15% rate. And people expected that it would never fall. That's the nature of things when human beings are involved. We tend to project past experience. And so that was 25 years of a one-way market. And we have recently had a 40-year experience. So imagine the pent-up expectations, as it were, the hard wiring of anticipation. You have to have either a great imagination or a lot of birthdays under your belt to even conceive of the possibility of a time of persistently rising interest rates. That's me. I happen to have read about it, written about it, and lived through it, and I can certainly imagine such a thing and expect it. And I should say, by way of full disclosure, that I began expecting it a long time ago. So you're not talking to a pinpoint market time here. But Jacques Rueff, a very a profoundly important economic thinker of the mid-20th century, had a phrase he called the age of inflation. That was the title of one of his collection of essays, Age of Inflation. And what he said basically was that a world removed from the gold standard, a world given over to the more or less uninhibited and unconstrained issuance of paper currency, is a world that is inclined to, is bound to inflate. And I think that's the world we live in. And so it'll, if I'm right, and who knows about that, but if I am, people will have to make adjustments to what they are going to expect from financial markets, because it'll be a very different world than the world we have seen for a long time.
So today people think that there might be just 2 more hikes and then we are going to be done with it.
Yeah, well,
So
that is a hope.
that is the hope, and that's what the market seemed to be sort of assuming at this point in time, because it doesn't seem to be a terrified markets that there is going to be a very steep rise or a very prolonged rise either.
Yeah.
So
well imagine what it would take for the well-compensated employee of a major investment bank stand up and say, well, the financial assets by which we have all gotten very comfortable and some of us very rich indeed, these financial assets, stocks and bonds, have reached rather a point of inflection, and what has worked for the past 4 decades will no longer work or will work with difficulty. And everything that we know must now be reappraised. And I think, says our imaginary highly paid employee at a leading financial institution, I think that we are all going to be unpleasantly surprised for many years to come. Now, that is a speech that you are not going to hear from our imagined employee at a leading financial institution. That is simply not done. Which is not to say that what I say is true or is imminent, but the impediments to even conceiving about a change in the world's basic financial mechanics, that impediment is immense. People just don't want to think about it. It has been so very pleasant thinking about the thing we have experienced and enjoyed.
And what kind of probability will you attach to the Fed rates going to about, let's say, 5.5% within the next 1 year or so?
I think that is low within the next 1 year or so. But if again, and what a word is if I am correct, um, the trend will be in rates will be upward for a long time, and it will not be, it'll be jagged. It will rise, then pull back a little bit. But I think that um, that in the face of what is now an 8.5% inflation, and what may simmer down to be a 5% inflation or a 4.5%, I think the appropriate rate of return for the holder of a fixed income security is something in excess of 4.5 or 5%. What you need is a real inflation-adjusted rate of return, both for reasons of equity and reasons of financial coherence. You can't invite people or command them, really, to lose money over indefinite periods of time. So interest rates, I think, are going higher, both in nominal terms and real terms. And underlying that trend will be a rate of inflation that does not gratify the central bankers by reverting magically to 2.1% or 1.9%. In the mid and late 70s, the central banks were hoping against hope that things would resolve themselves and that the central bankers would not have to exert themselves and to burden their many constituencies with the rates of interest that became necessary. But they did. And the world wagged on. It wasn't the end of the world. But I think now that people are reflexively returning to the world that has been there, reflexively returning to the world of low interest rates, of low inflation, and of a world in which the central bankers are imbued with magical powers of competence and foresight, which, to be sure, they do not really exhibit, but which they are believed to possess.
Right. So, in the absence of low interest rates or near zero interest rates, which is what the markets would love, the next best thing in today's environment that the markets hope for is a kind of a soft landing in the US.
Very
So, it can
convenient.
be
Yes,
really hike interest rates in a way that doesn't cause great damage to the economy. And this time, of course, Jerome Powell also said that there is, that there is a path to a soft landing. That's what he hinted. Do you think that's a possibility at all?
sure. I mean, uh, so many birthday candles have I blown out that I rule almost nothing out. I've become much less certain about the future as the years have worn on. So I hope I don't dogmatize about things the way I might have done when I was a mere child at the age of 50. But a soft landing is a possibility. Certainly, it is the one the market would prefer. It is the one that everyone is hoping for and talking about. But what does that mean? It means that the Fed dexterously and artfully raises interest rates just enough such that consumption pulls back by the desired increment so that prices clear at a lower level, and that the financial excesses that have characterized the past decade and a half are magically resolved, and we all settle into a new cycle that begins, et cetera, et cetera. So I don't see that. And the reason, I guess one reason I don't see it is that I think we have yet to pay the bill for the misallocation of investment dollars or rupees that attended the decade and a half of 0% interest rates and so-called quantitative easing. Interest rates are, this begins a sermon that I often give, but interest rates are kind of a universal price, and they are, as it were, financial gravity. And without interest rates set in the marketplace at reasonable and logically acceptable levels, we kind of live in a zero gravity financial world. You get things like, you get crazy things. You get great explosions of venture capital fantasy. You get non-fungible tokens. You get cryptocurrencies by the trillions. You get a fantasy world of speculation, which I don't mean to sound like a killjoy or an aging baby boomer, which I certainly am. These things are not strictly normal. They are cyclical. They are cyclical sightings, and they are cited at moments of the greatest financial abandon and recklessness that are often, if not always, the products of monetary profligacy. And what we have had is nothing if not monetary profligacy. And we've had it for so long that it's come to seem normal. 0% rates have come to, so entire industries have been built up on phony interest rates. The private equity business, which is a great force in this country, both for financial speculation and actually also a force in politics. That is a product to no small degree of these little teensy tiny interest. You can hardly see them, so tiny insect-sized interest rates. Unwholesome interest rates.
Absolutely. I was just about to come to this point, and you have already mentioned it, that the biggest risk really is of, near zero interest rate is, you have so many investments and businesses that have come up that have a very low threshold. And I think the markets have already discounted that in the way the tech stocks have corrected, cryptos have corrected, and all of that. Do you see any large pockets of weak spots that are yet to correct, and that could be vulnerable to the trajectory from 3% onwards?
Sure. I think there are a lot of them. I think in no particular order, there is still the crypto world. There is, more substantively, there is venture capital and private equity, which by definition is not marked to market in a public way, but is rather, its prices are imputed or projected or confected. And real estate is another area in which interest rates have had their effect, and commercial real estate is, to be sure, not marked to market every day in the New York Stock Exchange. So if interest rates do persistently rise, if price earnings ratios contract, if revenue growth slows, if it becomes more difficult to service one's debts out of cash flow, the consequences will ripple through the economy in a more deliberate fashion than those consequences roared through on the NASDAQ stock market earlier this year. So I think there are great pockets of vulnerability, and those pockets to be marked to a large extent are hidden from public view by the nature of the financial reporting that concerns them.
One of the questions I must ask is, while this, splurge has been across the world in terms of monetary policy easing and easy money, inflation right now in India, for example, is 7%. In the US, it's 8%. And India has lived with a 7%, 6%, 5% inflation right this millennium. It's not extraordinarily new, but
Yeah.
for US, it's a 40-year phenomena. So do you see this divergence sort of continuing, or do you see inflation becoming a global issue? How do you see this, and what does this mean for interest rates globally?
Well, I think it is now a global phenomenon. I think it's more exaggerated some places than others. For example, Germany, which is uh, uh, which has proverbially been a land of monetary orthodoxy and of inflation phobia. Of all places, Germany is registering rates of inflation unseen since the uh, early years following World War II. It's been quite an extraordinary thing in Germany, more so than, or as much so as in Britain. Japan is an outlier, as it usually is, but even in Japan, there are intimations of a rising rate of inflation. So I think it's going to be global. Most consequential financial trends are um, international, are not purely domestic. Um, so I think this, and I think one can also make this argument from the point of view of of global bond yields as they were at the lows in 2018, 19, and 20. I think history will mark those years as the most extraordinary demonstration of the excesses of modern central banking policy and weaknesses of modern central bank thought and analytics, when posterity considers that during those years, something in excess of 15 or 18 trillion dollars worth of fixed income securities, or so-called fixed income securities, were priced to deliver nominal yields of less than zero. That is a concept that was a consequence of these aggressive central bank policies of interest rate suppression. It was also a consequence of the belief system of investors that they had come to accept that bonds were no longer um, defensive instruments that were uh, of limited, inherently limited upside appeal, but they came to think of bonds as something else, as great speculative vehicles. So the very phenomenon of $1.5 trillion worth of negative nominal yielding bonds, I think, speaks to how extraordinary was the bond bull market, and on form, such extraordinary excesses in one direction typically give rise to a reflex response in the other direction. So I think that we will live, I hope you do, I don't know, I hope all of us do, live long enough to see the market reconsider what it suffered, and what it part and what it um, helped to bring about in 2018, 2020, and to redress those excesses with just a little bit of excess in the other direction. And that'll be a wholesome thing. I look forward to watching for it.
And what does this mean for global fund flows? Does this change the course of the way inflation behaves across different countries? Do you think will alter the course of fund flows in any way?
Well, I think that fundamentally what we're talking about when we talk about rising interest rates is the recalibration of valuations of financial assets and of investment opportunity. And So I'm not sure about flows of funds, but I think that people will have to face the fact that rising rates of inflation and rising rates of interest are kind of the kryptonite of the Superman of financial investment. Stocks and bonds were seemingly invincible over the course of so many cycles since the year 2009, indeed for many years before that. And what made stocks and bonds go up was not only the world's progress in material matters, these great cycles of invention and adaptation that we have seen since the dawning of the machine age. All of that, to be sure, was part and parcel, was cause rather of the appreciation of stocks and the improvement in credit quality of corporate bonds. So fundamentals played their part. But what was integrally important was the fall in rates of interest, the seeming central banks' dominance, conquering of the problem of inflation, and the expectation that inflation and interest rates would trend lower and lower, not perhaps stopping even at zero in the course of many years in the future. I think all of so that the observation of very low rates of interest and the hope of more of the same was a great propellant of stock and bond prices and of returns and of expectations. And on Wall Street, they say, my late friend Richard Russell was wont to say that markets make opinions, that expectations guide. Expectations have their foundation in experience, and people project what they have seen and what they hope. So what we're talking about here is an overhaul of expectations, which will be a very, very gradual process. People would most grudgingly come to accept a new thing, a new unfavorable thing having to do with inflation and interest rates. The central bankers will have to be dragged into it themselves. They want so to be able to say, done and dusted. We have raised our rate of interest from zero, in the case of Christine Lagarde, from less than zero to zero. See what we have done. Well, zero might not be good enough to stop inflation raising at 10%. So, also people's temporal sense, their sense of time, is so impatient. They can, everyone is sitting on a cell phone about ready to tweet his or her approbation of the central banker that says the cycle is over. So maybe the cycle's not over. Maybe the cycle is going to persist, in which case people are going to have to stop tweeting that it's over. So it's not only an age of inflation, but it's an age of impatience. And if the cycles of interest rates still are intact, and if a 40-year down cycle in rates is going to give way to a long-term upcycle, people are going to have to adjust to that. It will not be easy, just given the seemingly the impatience of the age.
So in terms of stock market itself, do you think one should expect a sharp correction and then a consolidation phase, or this whole process itself going to be a prolonged, painful period?
No, I'm probably the world's leading authority in what the stock market is going to do in the short and intermediate term. I think, what we try to do here at Grants is to look at individual opportunities from the point of view of valuation. Not exclusively, but we pay greatest attention to price and to value. And we observe, and anyone is free to do the same, it's not a military secret, we observe that in very few cases are prices and values commanding attention would-be buyers. I mean, I think the market is still relatively richly valued. There are pockets in certain situations that are rather more appealing. But I don't think the stock market is a bargain. And if you look at price-earnings ratios, add to price-earnings ratios the rate of inflation, you see a kind of a financial misery index. You know, to get a misery index, you add the inflation rate to the unemployment rate, and that is the time-honored misery index, at least in my country. But if you add price-earnings ratios to the inflation rate, you get a kind of a different financial, misery index, and that is still looking elevated. So if rates are going to continue to work their way higher, and if the inflation rate is not going to diminish to such an extent that central bankers will feel comfortable declaring victory, I think that's a problem for the stock market. And I don't know how the stock market is going to adapt, but it is going to have to eventually.
So one last question, Jim. The dollar so far has been the safe haven in the global markets, right? So every time there is turbulence in the financial markets, money really moves back to the US into the dollar. Do you see a certain point, or would you watch out for something that could actually be potentially a breaking point for the dollar?
Yes, such a thing could happen. Indeed, it did happen in the deep, dark years of the 1970s. There was a dollar crisis that had to do with the Fed's lamentable response to the inflation that it indeed helped to precipitate. And you couldn't cash a dollar traveler's check in Europe without the hotel clerk looking at you and saying with his eyes, so dollars, is that all you have to offer? So the dollar today is the world's, of course, leading currency. It's proverbially the world's reserve currency, but nothing is forever. And it's possible that the world will reappraise that. Now, what might cause the world to reappraise it? Well, if the Fed decides that it would rather not do what it had to do to control inflation. And all of that remains to be seen.
Sure. Thank you so much, Jim. It was such a pleasure talking to you. Thank you so much.